Hello, welcome to News Center. I'm Parikshit Luthra. Let's start with the market action. A last hour fall meant Sensex and Nifty ended the last trading day of 2022 with marginal losses. Financial stocks dragged the indices even as mid-caps managed to buck the trend. For the year, both Sensex and Nifty have gained just under 5%. This is the 7th consecutive year of gains for the markets, but this is the first time since 2018 both major indices have clocked returns in single digits. Manglam Malu wraps up the year that was on Dalal Street, explains how India fared in comparison to the rest of the world.
How did we fare against the world? We were standing tall out there as well. The Indian markets did a 5% gain as against the Brazilian markets just under 5%. And we far outperformed developed markets, the likes of Dow Jones, Hang Seng, as well as NASDAQ, all of them. NASDAQ was down 33% in 2022. But we also saw weakening in the currency because of the Fed rate hikes, etc. The USD versus INR pair, the rupee depreciated by about 11%. So compare it in dollar terms, we actually had a negative return of 5.5%. There was massive FII selling, right? 2.75 lakh crores. That's the amount that FII sold in 2022 in our cash markets. The domestic institutional investors, the resilient ones, bought 2.73 lakh crores. If you just take a look at the way the FII sold, this is the highest that we've seen in a calendar year in the history of our markets. So in light of that, how did the other indices fare? The Nifty Bank was a strong outperformer, 21.5% higher. It was a weak year for the broader market, so the mid-cap index just managed to close in the green, but the Nifty small cap was down by 14%. Let's drill it down to individual sectors. It was the year of PSU banks, 70% higher on that index. The metals grew about 22% at an index level, but it was a fair amount of weakness for the pharmaceutical pack and the IT pack, one of the weakest years that we've seen for the IT pack in the last many. Individual stocks, the latest entrant onto the Nifty was its top performer as well. Adani Ent did 125% in terms of gains. ITC got the top honors board as well. A lot of jokes notwithstanding, this year was the year of ITC with a 54% gain out there. Coal India up around 52% as well. A lot of the old power companies came back. NTPC up 34%. In terms of other underperformers this year, however, the IT pack, like I said, stood out. Wipro leading the way down. 45% cuts out there. Tech Mahindra down 43% as well. Divi's Labs did not do too well either. And HCL Tech Infosys down 19 to 21 odd percent. This year was the year of PSU banks. Like I said, 144% gain for UCO Bank. Canara Bank was up around 60 odd percent as well. SBI 33%. In terms of other sectors that did well, it was the defense stocks. Mazagon Dock almost 200% higher on that one. If you invested your money at the start of the year in Garden Reach, you would have doubled it. BEL itself would have given you around 43% in terms of returns. But that's not all. We had some other mid-cap gainers as well. Indian Hotels 75% higher. TVS Motors zoomed ahead 73%. Cummins and Federal Bank up anywhere between 40 to 66% too. In terms of losers though, we had the mid-cap IT names, Mphasis, FirstSource, Birlasoft. All of them would have halved your money. So would IEX, in fact, from the start of this year, down 44%. We were coming off a COVID year, so we saw some declines in all these diagnostic companies as well. Metropolis, Dr. Lal, falling anywhere between 40 to 60 odd percent. And this was also the year where we saw all the new age businesses decline, and how? A big cut, anywhere between 50 to 60% on Paytm, Zomato, Nykaa, PB Fintech, Delivery, even car trade was down 45%. But let's end on a positive note. There were a lot of gainers from the broader markets. Adani Power up almost 203%, NDTV 210%. It was the year where sugar did well as well, 240% for Ugar Sugar, and FACT was up 180%. So that's the year that was 2022, an eventful one for the markets.
Let's now shift focus to India's rising imports and declining exports, which has pushed the current account deficit to a 9-year high to 4.4% of GDP. The deficit stood at more than $36 billion in the second quarter of FY23. The number in Q2 is double of $18 billion recorded in the first quarter. It is also nearly 4 times higher than the $9.7 billion reported in Q2 last year. With this, current account deficit for the first half of the fiscal also rose to 3.3% of the GDP. For the second quarter, the CAD is at 4.4% of GDP. Let me now go across to Rajiv Kumar, economist and former vice chairman at NITI Aayog. Mr. Kumar, the merchandise trade deficit is the culprit here. How concerned are you about these current account deficit numbers?
Hello, Parikshit, and thanks for having me. On the current account deficit, I think it's just a blip in this quarter, and I think it should settle down again. And I say this because what happened is that the exports have been hampered, have sort of faced the the poor conditions in the global markets, and therefore their growth has been very slow. But our imports have continued to rise, both on account of our economic activity as also the higher commodity prices, which are the oil prices as well as the other metal prices. So I think this is just I should think it's a temporary phenomenon, because unfortunately our economic activity is likely to slow down, which would mean that the imports would not rise as fast as they have done in the past, and exports also, with the FTAs coming along, etc., would begin to rise. So this is just a one-quarter phenomenon, and I hope we'll be back to more sustainable levels in the coming quarters.
Right. How do you think we will fare with our current account deficit in Q3 and Q4?
I think we'll be to about, I would have thought about 3% in Q3, and then my take would be about 2.8, 2.5, 2.8% in Q4, because that's the, that's where we'll get advantage of the cheaper oil deliveries from Russia, so that thing will settle down. Our food prices are global; they would be down. The commodity prices are beginning to weaken because of the Chinese growth story beginning to is faltering now at this point of time. And hopefully our services imports and our remittances, it's a robust segment of our foreign exchange earnings even now. I think they will pick up even more. So the current account deficit overall for the fiscal year 22-3 after the Q3-4 would, I think, come to about 3.3%. And it's a tad higher than what we consider to be the safe level of 2.5% and below. But I think given our foreign exchange reserves, given the overall resilience and the likely foreign portfolio flows, etc., I think these are well within manageable limits.
Right. In terms of imports, we've seen a 30% rise in imports, and non-oil imports have also risen by 25%. Do you feel that this is a cause for concern? There are some measures that we need to take in order to increase our exports, considering that the global environment is not going to be very conducive as far as export growth is concerned?
Yeah, so the two-part answer to this, Parikshit, which is one, that we don't need to take any sort of unusual steps on the import side to curb imports, etc. No point raising tariffs and or non-tariff barriers and so on, because these imports reflect necessary imports. Not too many of them are in the nature of high consumption imports, etc. What we need to focus on, and which is why I'm glad to see the Ministry of Commerce now in active, some action mode on signing our free trade agreements or fast track agreements, is to focus on our exports and our export earnings. Now, it has been India's situation that our exports rise when the rate of growth. We haven't been able to improve what we need to focus on. And I think the way to do it would be to focus on a few sectors where we think we have the competitive and the comparative advantage, and to try and get a much higher share in the world markets for those particular industries and sectors. So I think that's the focus that we now need to do and now need to have. I've been arguing this for a while now, and I think time has come that we get this action in place of focusing on selected export winners and ensuring that they double or triple their share in world markets.
Right. Are there any particular sectors that you would like to flag off? Because when we compare to Vietnam, Vietnam today has FTAs with 56 economies, and that does put the Vietnamese economy at a considerable advantage compared to its Southeast Asian peers. Give us a sense of some of the sectors that we need to focus on in terms of increasing exports, the markets that we need to try and seize, and some of the measures that could be taken in that direction, Mr. Kumar?
Yeah, so Parikshit, these are pretty much well-established winners, and then there are some which I think we should convert to winners. See, clearly there is a gems and jewelry sector, which is which has been there, has been a winner for a very long time. So that's one, but that increases our gold imports as well, or diamond imports as well. So but that's one. Secondly, we've lost considerable market share in our garment exports, and there is no reason for us to lose market shares to our neighbors like Bangladesh or Vietnam, etc. Now, Bangladesh does have a sort of a fair, a preferential treaty with the EU, but then our market for our garments like West Asia or the US and Europe or high-end designer markets, I think, can be really captured. And we have to reverse the decline in our garment exports in a major way, because that's one sector which needs significant focusing, because it has been and it can be a winner both for export earning and for employment generation. The third, I would say, is the high-end, high-tech manufacturing exports, not the low-tech ones, because we can't compete with the Vietnams and the southern Chinas of the world, the large assembly lines, etc. But our high-tech manufacturing exports of, for example, complex forgings or castings, or even some equipment, including defense equipment, can be made into a winner. Now, I think that's something that we need to really work on. But that's again is a major player. Now, finally, I would say that we have been very conservative on our mineral exports, on our and in some cases like iron ore, we are a very rich. We've got very rich reserves that can last us for 400 years plus. But we have taken a policy stance that these reserves are meant only for our domestic producers. There'd never be shortage of supply for our domestic producers, and we can actually increase those exports. So those are some of the areas where I think we can do much better in exports and goods. And then apart from that, of course, our services, not just software, but also education and health services, I think can be very important in this regard.
Mr. Kumar, I'd also like to ask you about another story, and let's just take our viewers through it. We're learning from our sources that the government is reviewing its stance on investments from China. Yes, the investments of China, as per restrictions imposed in April 2020, continue to be under government route, but at the same time, the government is now actively looking at Chinese JVs, which can benefit us in a strategic way, in a manufacturing way. We want to focus on certain intermediate stage products where we don't have expertise right now. We want the likes of Apple to manufacture iPads in India. And the feedback is that we will need to have JVs between Indian entities and entities like BYD as well, if we want that manufacturing to take place. Do you feel this is an important step that the government must take investments, have joint ventures with China where it serves our strategic and manufacturing interests right now?
Parikshit, this is actually music to my ears. I've been arguing for this, in support of this, for a very long time, because Chinese companies, China itself has huge capital surplus. They keep exporting this surplus abroad, and I think see no reason at all for us not to have these joint ventures and invite investment from Chinese companies. Because I think it's important to have them put their money in the ground here, because that will also benefit our overall relations. I've always argued to keep our security relations and our economic relations with China separate, and and treat them as two different entities or two different tracks. And I think this will be very useful. In fact, in the last couple of years, the reverse has happened, which is companies like the Great Wall Motors of China have closed, who had bought the entire Ford plant in India had shut shop and gone away. And I think this is time now to review this. And I'm glad to hear that the government is reconsidering this, because we can get investment, we can get technology, and we can get also some markets, in this case. So I think I take it as very good news, because there is no reason for the Chinese investment to go to all other Asian economies and not come to the largest Asian economy in our largest Asian economy, which is what we are.
So we also believe that in 2020, BYD was keen to have a joint venture in India to have iPad manufacturing, but that could not really take off because of the geopolitical environment after the Galwan clashes. Do you feel that we have somehow lost out in the global China plus one strategy to Vietnam? Today, Vietnam has emerged as the top alternative when it comes to high-tech electronic manufacturing, and the bulk of companies who want to have alternate supply chains are looking to Vietnam, be it Samsung, be it Apple, be it Google for that matter, or be it Microsoft.
Well, we can and we should give Vietnam a run for its money. We had, for example, Apple, as a NITI, partly instrumental in bringing Apple to produce their iPhones and their other, and then their chargers, etc., in their plants in Pune, and then have, I think now about more than $300 million worth of exports. And their vendors have been trying to shift, but have faced some resistance because of geopolitical reasons. I think this China plus one thing, which is very clear that people, companies were looking for an alternate location for their manufacturing. India must take advantage of that and offer terms which are good enough to attract these companies here. These companies are not Chinese companies; these are foreign companies producing in China, whether it's Taiwanese or Korean or Japanese, and there were efforts made already by our embassies, I know, in Tokyo and in Seoul, to do so, and I think these efforts need to be redoubled because we should create the right conditions, whether it's zones or whether how to reduce the project risk or the land acquisition risk, etc. And I think if we do that, and maybe the buck will stop with the state governments, and that is where I think we should put our focus on. The central government should encourage the state to, in some sense, compete for these investments, because now it's the right time, and I think India should make use of this opportunity and to attract large-scale manufacturing. The PLI scheme, major part of the reason for the PLI, which we launched from NITI, was this. And I hope that will succeed. And if it does, then we will be able to compete with the Vietnams of the world to attract this investment into India.
All right, Mr. Kumar, thank you very much for joining us with that comprehensive view on India's current account deficit, which is at record levels over the last 9 years, and also how India is reviewing its strategy when it comes to Chinese investments. We're going to take a short break at this point, but don't go anywhere. We've got important stories coming up. India's real estate developers are turning to tech-driven tools called Proptech to drive sales and boost conversion. Also, a special report by my colleague Ashmit Kumar on what the mobile phone and electronics industry is seeking from budget. Welcome back. The union budget is about a month away, and ahead of this, the electronics industry has sought a 5-year extension to the scheme for promotion of manufacturing of electronic components and semiconductors. The industry has also flagged a liquidity crunch. Ashmit Kumar is here with this exclusive. Ashmit, what are you picking up from the industry and the government?
Well, there's a long list of demands that has gone to the Finance Ministry, but just to highlight the key takeaways, as far as the spec scheme is concerned, the sunset clause is March of next following year. Under the scheme, the government provides financial incentives of 25% on capex. The industry now is seeking an extension of the scheme by 5 years with an additional outlay of 10,000 crore rupees. Further, the industry has red flagged what it calls the tariff structure and says that there is a need for overhauling this tariff structure because it is making India uncompetitive as compared to some geographies such as Vietnam, Thailand and Mexico. Staying on the taxation front, The industry body also, in fact, points out that there are concerns with respect to input tax credits. Large amounts of funds are stuck there, which causes a liquidity crunch for the industry. Also, that there are a large number of pending cases and that there needs to be some form of alternate dispute resolution to escape these anomalies here. As far as specific demands that are being made, well, there are cuts in custom duties that are sought for a whole host of key products and key components in electronics, but importantly, a customs duty of 20% is sought to be cut, especially as far as high-end phones or phones costing above 20,000 a piece. Also on the GST front, they are pointing out that mobile phones should not see a levy of 18%, but should be cut down to 12% as it's slowing down the Digital India mission.
All right. Thank you very much, Ashmit, for joining us. And let's see what the budget has in store for the electronics industry and the mobile phone industry as well. Shifting focus now, India's real estate sector is seeing a revival, but the way property is being sold, especially residential real estate, has undergone a change since the pandemic set in. CNBC-TV18's Shraddha Tiwari and Arundhati Ramanan report that developers are turning to tech-driven tools called Proptech to drive sales and boost conversion rates.
For years, real estate companies used websites to attract potential customers, their own or platforms that provide property listings. But physical site visits were an integral part of the selling process. This started changing a few years ago, with some developers offering online tours of their projects. The pandemic sped up this adoption of technology, and companies now offer a lot more. From virtual tours to interactive immersive virtual reality experiences to extended reality simulations. They give aspiring homeowners a sneak peek into what living in the finished project will actually feel like.
Technology, which about a decade back was used only for, backward integration, like a CRM and all, now has taken a front seat. So in forward facilitating the brands, right? People want to, real estate brands globally want to create memorable experiences for their prospects, so that, in this cloud of offerings, they are able to stand out.
Consultancy firm Aayog says that globally, conversion rates have risen to 40%, and much of this surge can be attributed directly to the use of new age tech as selling tools. Of course, this also means a jump in sales and revenues.
Earlier, they would take 6 months to buy a property by understanding things. With technology in place, the duration of buying cycle has reduced because you have a lot of clarity, and that is even happening at the local sites also.
It also gives the builder a cost advantage in the long term, even if the technology is costly to begin with.
Here we are, and these technologies come in place, wherein the buyer can experience the entire sample house without actually being constructed by the developer. So that saves on the money, that saves on the time, that saves the resources also.
It's not just high-end luxury projects that are adopting such technology. Aayog says that mid-range and affordable housing projects account for 56% of new launches in the third quarter of 2022. And a lot of the buyers are millennials with whom such technology resonates. But experts say the technology is constantly evolving and expensive, so adoption has been relatively slow.
We've seen specific to India is real estate, as most people know, is a really family-owned business, right? And it is the second, third generation that has gone abroad, studied abroad, got exposed to new technologies, and they're coming back to India now and taking over the reins of the company. So these are the people who are really pushing for efficiencies, and efficiencies everywhere, not just back office efficiencies or financial efficiencies, but also sales efficiencies now. So that is where VR, virtual reality as a technology really, really helped. I've been surprised, pleasantly surprised. Tier 2 cities are actually more acceptable to trying out new technologies than Tier 1 cities.
This new trend has opened up a whole new market for startups in India.
Technology for real estate developers is no longer about hiring a website developer. It's now about immersive experiences and holograms. Stuff that lets a potential buyer walk around in a home that's still under construction miles away and play around with the interiors to get a real feel for the space. This has created a whole new high-growth sector. And while the Indian startup ecosystem has been complaining of a funding winter, Proptech enterprises have seen private investments jump 55% between 2009 and 2021. In Mumbai, Shraddha Tiwari.
All right, thanks Shraddha for getting us that report on the real estate sector. With that, it's a wrap on this edition of News Center. Don't go anywhere. News continues on CNBC-TV18.